Hello, everyone. My name is Greg Harnett. You can look me up on LinkedIn under Gregory Harnett, Harnett. You can also go to my website, 65exam.com. Now, what we're going to learn today is part of Chapter 1 of the Investor Handbook. I wrote it over the years. I've written many books for investments, basically for training brokers and agents for the insurance licensing and broker trainees for their security licenses. Series 6, Series 7, Series 63, 65, 66, and the new SIE, as well as life and health, property and casualty. Now, what we're going to do today is just review the text of Chapter 1, part of it, pertaining mostly towards the introduction and common stock. We'll get into a little bit of, other areas, but the basics is I want to touch on common stock, and then my next video will basically have more of an overview, a review with the math, with the calculations, with whatever we come across. We're going to address it in the next one. We're not going to do it right now. Okay, I just want to get the concept in, and I want to get you an idea of what to expect. Now, if you wanted to get the Investor Handbook, let's see, right now it's 163 pages, I think it is, and it's on my website, 65exam.com. And you can just contact me and arrange for one of the books to be sent. I can send it electronically, or I can print one up and send it out to you in hard copy. The hard copy is more like a binder, a study binder, because I use a lot of the content from my other classes, my other books in this. And if you look at my introduction, my first video, you'll get a better idea on how I created the Investor Handbook. But the bottom line is it has a lot of what is in the stockbroker exams and the registered investment advisor exams, books, training material. But it has far more content in research, portfolio management, investment analysis, all that. How to put it all together is the last chapter. So you're going to have to stick with me or get it to find out what's going on. Now, let's take a look at the very beginning of the chapter. It starts out with a security is, what's a security? A security is an investment that represents ownership stake or a debt stake. A debt stake. Ownership stake is stock. Common stock or preferred stock. It's stock. The owners of that stock could receive dividends, or maybe they don't. Maybe the company just reinvests everything into the company, and that you're going to see more into a growth-oriented company or a tech company, the startups, the younger companies that went public. They've been around for a while. They have a reputation. They went public, and then all of a sudden now they're growing and they're growing. But do they want to keep giving dividends out? That's passing on the assets of the company, and that limits what they can do. So some companies, some industries are very strong at not providing a dividend. And the investor needs to be aware of that, because a lot of times we'll get it also questions when I worked for different investment firms that say, why doesn't this company pay me a dividend? Well, that's not the purpose of that stock. If you're looking for dividends, why did you get it? Oh, it's a growing company and I expected it. You expected them? No, you don't expect companies to pay dividends or to do things the way you think is right. They're doing it the way they feel is right because they're there right in the trenches. They know the business. They know the company. They know what's best for it. Now, companies that do pay a dividend typically are going to be like energy companies, um, utility companies, food companies, the basics, the real grassroots uh, of the businesses, the various industries. So investors who want to rely on dividends, who need it for regular income in their retirement, they will get dividend stocks from those companies that pay a regular dividend. And we're going to learn about that as time goes on. But what we're looking at now is what a security is. And I'll be honest, it's not as clear cut as it may seem. A security basically represents the ownership stake or a debt stake, like I said. Now, ownership stake, as I mentioned, was the common stock and preferred stock. But the debt stake, what does the debt stake mean? That refers to debt securities like bonds, notes, commercial paper of a company. We're going to learn all about that in the different chapters. In fact, chapter 2 is on debt securities. So now what we have to learn is the easiest way to understand debt securities is you are giving a loan to a company or a government. Whether you like that company or not, I mean, you invested in it, of course you like it of some sort, but whether you want to admit it or not, if you bought a bond from a company or a government bond, a US government bond, or a municipal bond from your school district or from your city or a state, you gave that organization a loan and they're paying you interest, not a dividend. We're going to, we need to be specific about that. It's not a dividend, it's interest. And in my opinion, this is just my opinion, there's a reason why debt, loan, bank, bond, they're all 4-letter words, aren't they? Okay, I got that out. I feel much better. It's my intention is, as I write there, is not to demean debt securities. It's to open your eyes to what you're doing when you invest and how you invest your money. Okay, if you're one of the people who are angry at banks because of the way they loan money or anything like that, well, that's what you're going to be. You're going to be a banker. You're going to loan money to an organization. You're going to, hopefully they'll pay you back. So now you're going to get to see it from the other side of the business as a loaner in debt securities. Now, I mentioned interest and dividends. So what is the difference? It's all in ownership and how the money is reported on the company books or the organization's books. On a company that loans, that has bonds, and they receive money and they pay interest, the interest is an expense to them, so they can deduct that. So it comes out of the books before you see net income. And then after the income is determined on a company, then dividends are paid. So a dividend to you or any investor from a company is not an expense to them. They can't write it off, but they can write off the bond interest. And that also gets into the question, do we issue more stock, or do we issue a bond when a company is trying to raise money? In some cases, remember we spoke about dividends, and we talked about when a company would pay dividends and not pay dividends. A company that pays dividends, like let's say in a utility company, they're very tight on issuing new stock. And the investors say, yeah, but just borrow more money, issue more bonds. They don't want to dilute the dividend. Okay, that's the whole idea. A company that issues dividends regularly and the investors want those dividends, they don't want more stock out there because it dilutes their ownership and possibly dilutes their dividend. So if it's a loan and it's a bond, all that company has to do is make 1 penny more than the operation expense and the loan expense on the bond to provide more equity and ownership into that, more income to the company, and the investors love it. So think about it that way. That are you an equity investor or are you a debt investor? And sometimes you're both. You should be, but I more or less like to sway away from debt securities and sway more into higher dividend through preferred stock, because preferred stock is basically a higher dividend, much higher dividend. It gets priority over common stock dividends, and it's an ownership situation. Not much of an ownership situation, because the common has the true ownership control. It doesn't vote. So let's take a look at a company, investigating a company, looking into the company that you want to invest in. And now we're on we understand security. It represents ownership, stake, or a debt stake, but it also is risk. There's an investment risk. It has to have risk. If it doesn't, then it's not a security. And I spoke about it in the earlier session. I want to repeat that. Even the SEC didn't know what the heck a security was, and they're the Security Exchange Commission. They should, right? But they fought the insurance companies like crazy for years in the courts. And the courts kept saying, hey, that equity insurance product cannot lose money. There's no risk. That's not a security. So that's basically the standard in America right now is, can the money that's put into it be lost? And if the insurance company says, hey, if the market goes down 30%, you're still not losing any money. Well, that's not an investment then. When we get later on in the book, we're going to learn about variable life insurance, variable annuities. Those are a security because they're a combination of a sister mutual fund and the insurance product. And that makes it a security because you can lose money in those. So let's go a little further. Now we're looking into the company and we're trying to consider what company, but first we got to look at the books. We're not going to get a lot of the books, but let's start with the balance sheet. What does the balance sheet do? Well, what does the balance sheet do? It balances. What does it balance between? It balances between assets of the company and liabilities and owner's equity. Owner's equity is also called net worth. So you take all the assets and do the formula. Assets equals liabilities plus owner's equity. And owner's equity can also be called net worth, whatever you're comfortable with. So when you see a positive amount after you subtract out the liabilities, that's the owner's equity. That's what the common stock owners own per share divided by the number of shares outstanding, and that's the book value. Okay, so you got a formula here. Assets equals liabilities plus owner's equity. So let's go back to grade school math. When you subtract from one side, you got to subtract from the other side, right? So let's subtract liabilities from the right side and put it on the left side. So assets minus liabilities equals owner's equity. Once you know the owner's equity, divide it by the number of outstanding shares in the marketplace, common stock shares. And that's the book value per share of the company. It typically is going to be a number significantly lower than the market value. So don't worry about that. But as long as the assets outweigh the liabilities, then I consider it an opportunity to consider, I say, Not jump on board all the time every time you see a company that has, positive. So look at it. Now we want to look at assets. That could be anything from the land, the building, the equipment, inventories, raw materials, accounts receivables, people that owe the company money. And there's also intangible assets like licenses, patents, rights that may be transferable. Liabilities include accounts payables, as well as short and long-term debt, bonds, notes, commercial paper, um, other obligations of the company, the mortgage, you know. Owner's equity is what's left. It's the net worth, right? Now, I like to bring this up in the beginning just to get you a general idea of how to look at a company, but also, well, why don't you set your own balance sheet? If you're trying to expand your horizons and be in buddy buddy more with the banks and expand your life, you need to keep a balance sheet of your own. You need to keep track of your assets and your liabilities and show your net worth. And you need to show the progression. I would do it quarterly. Especially if you open up a new individual business, even if it's sole proprietor and in your home, and even if you're just doing lawn mowing, as a side gig while you're in college, whatever. Keep track of all your income, keep track of your worth, your net worth, your assets, and that. The banks will be impressed. They'll know that you can follow up. They know what you're doing. Let's take a look at common stock. There are 4 classifications of common stock to look at: authorized stock, issued stock, treasury stock, and outstanding stock. How does common stock get created? Well, when you form your company, you set up a company through your state or through the state that you want to. There are a lot of different, states that have different bylaws and ways of doing things to set up a corporation. I think there are 3 states that you definitely want to consider when you're setting up, let's say 4 states, okay? 4 states that you need to consider when you're setting up a corporation. First is your home state, where you live, where the company is going to be headquartered. Do you want to incorporate in that state? And it's not required. If you want to set it up in your company up in a different state, even though you don't live there, that's fine. You can do that. What you're doing is you're using their incorporation laws. Some may be better for you. And that's what you want to basically look into is what laws would work best for your type of a company. So look into your home state. It'll be a good comparison to start. Now, look into these next 3 states: Delaware, Wyoming, and Nevada. Delaware, Wyoming, and Nevada. And then, of course, your home state. Now, why those states? Delaware, if you expect to expand quite fast and grow and you're hiring people and you feel down the road, you're going to be going IPO. And you're going to definitely want an incorporation state that benefits people who go public. Now, it may be 3, 4, 5, 2 years, 10 years, I don't know, down the road from when you start. But it depends on your business and how you plan to expand that business. Or do you want to just maintain it as a mom and pop and or something that you work out of your home and generate regular income? Then it's not Delaware. But if there's a thought that you're going to be going public and you want to issue a large amount of stock, common stock, then Delaware is where you want to go. Now, let's take a look at Nevada. Nevada, on the other hand, and Wyoming are very similar. In fact, their incorporation laws are identical. How'd that happen? Well, we all know how to use a copy machine, right? That's how Wyoming became similar to Nevada. They just copied their incorporation laws. It's going to be difficult for you to find difference between them, except one. We know. Everyone who studied it knows. Everybody who listens to me knows the difference. And the difference is, in Wyoming, it's legislative law. Legislative law. That means the legislation got together and they formed it. And they formed it identical to Nevada law. So what's the difference? Nevada incorporation law is built into their constitution. So it would be much easier to change the incorporation laws in Wyoming simply because, well, maybe one party increases and they don't like it. For example, Democrats or Republicans. I mean, whichever party you're on. I don't know. I don't care about Wyoming laws. I just know they're copied from Nevada laws. So if you want to go to Wyoming and save a couple bucks, maybe go to Wyoming, incorporate there. But keep in mind that the laws, the incorporation laws can change as the politics of the state change. Okay? It's much more difficult for Nevada to change their incorporation laws because they need to change the constitution of the state. And you can't do that with a simple 51% or a 50.1. You can't do that with a simple majority. You need a supermajority, a 2/3 vote, to change the constitution of a state. So that's the difference. That's, Nevada, easy to incorporate. Wyoming, easy to incorporate. The only difference is the Nevada laws will change only with the change of the Constitution. And that means the laws are more stable. And you're not going to be stuck in a country, in a state where the incorporation laws change and bingo, you're stuck to there. Oh, geez, now what am I going to do? I don't like that law. Well, look at the laws. If they work for you, go to a place that won't change them so fast. So authorized stock, common stock. First, you go to the state. As I said, let's say we pick Nevada, just for the sake of this argument here. We go to Nevada. We go to the Secretary of State in the state of Nevada, and we go into their business development page, and we get the articles of incorporation pages, and we send our articles of incorporation with their application and their money, and we form a company. Now, when we do, we say how much common stock we are authorizing. We want authorized. And this has to be a much, much higher number than we need. Think of it as how much would you need for 10 years or 15, 20 years. So let's just say, for an example, authorized stock, we want 10 million shares authorized. And our par value is a 1/100th of a penny. 1/100th of a penny. All we're doing is setting an accounting figure up. That's it. It means nothing other than it's an accounting method. So we get approved for 10 million shares. Issued stock is how much of that 10 million do we want to now put to the owners? And who are the owners? So that's what we have to do. We have to declare so many shares. So let's say we do 500,000 shares. 500,000. And now we issue that to the owners. And here's the owners. It's going to be me, 200,000 shares. Fred, 100,000. Wilma, 100,000. And Betty, 100,000. So there we go. We got our 500,000 shares issued. I own 200,000 and each of the others own 100,000. that is considered now outstanding. It's not outstanding, it's outstanding. It's in the marketplace. It's in the investor's hand. It's in the investor's hand. It's not public yet. Okay. We haven't gone public yet. We're just setting the company up. So now we have authorized stock, 10 million shares. Issued stock, 500,000. Outstanding stock, 500,000. And outstanding is just whether it's private or public. It's in the investor hands. So at any time, we can basically go back and issue more stock. How much can we issue? 9,500,000, because we have 10 million authorized and we already issued 500,000. Now, as I said earlier, I'm going to get the next episode that I have, the next video, I'm going to get a board and we're going to go through all the math. I just want to get it out there to explain it in the beginning. Now, that leaves treasury stock. And right now we don't have any treasury stock. We have authorized stock, 10 million. We have issued stock, 500,000. We have outstanding stock, 500,000. Zero treasury stock. Now, what if Betty, for example, says, she wants to retire. She just wants to be out of the company. She doesn't want to do anything. She wants to sell her shares back. They can sell it. The company can own the shares if they want. The company can buy back the shares. And the company agrees. Let's say Betty goes to me and the other investors, Fred and Wilma, and all of a sudden we say, no, we don't want to buy them. And he says, okay, but the company will buy them. So the company buys it. And now the company gives Betty the value of those 100,000 shares. So now we have authorized 10 million, issued still 500. They're out. They're out of the authorized situation. Even though we bought them back, they're still issued. Treasury stock, 100,000 shares. Outstanding shares, 400,000. Okay. So even though myself and my other two fellow owners, didn't want to buy the Betty shares, we still own a portion of them because they're now inside the company. They're an asset of the company. They're treasury stock. Don't get it mixed up with the U.S. Treasury. It has nothing to do with it. It's just in our vault. It doesn't get calculations. It's not included in calculations for earnings per share, for dividend payout. It doesn't vote shares. It just gives everybody else a higher percentage of ownership. With 400 shares outstanding, I now own half the company. Before, I owned 40% of the company. Okay. We'll look at the math in the next episode. Don't worry about it. So outstanding share is now the 400, 200 from me and 100 from each of my other two colleagues. That's treasury stock. It's stock that's bought back. Why would a company buy back their own stock? Oh, it's easy. When the stock gets depreciated so bad, when we have economic hardship times, the company still could be paying dividends and still could be very profitable. But the investor confidence in the whole market or even that company just goes down in the toilet. Well, it drops the common stock price. And a public company would buy it back. In fact, Ford and American Express, they're very keen on buying back a lot of their stock. Now, why would they do that? If you're having tough times, or if the economy, let's say, is having tough times, and your stock price is going down, your investors are getting a little shaky and concerned. Some are selling, and all of a sudden the price is going down. More are selling than interested in buying, and that drops the price down. Now, you have a higher, because the company decides to buy back the stock, they can buy it at a cheaper price. And once they buy it back, the number of outstanding shares drops, right? We know that because we only have 400,000 shares outstanding. What if the company is paying the same dollar amount total in dividend? Our dividend yield is going to increase. Our earnings per share is going to increase as long as the income stays the same. But when you see this happening in the real world, in the marketplace, and they buy back 10 million shares maybe, now they have to do the calculations all over, and all of a sudden the dividend yield goes up, and all of a sudden the earnings per share goes up. It makes the stock look more attractive to investors. Time for a little root beer. Hang on. Oh, yeah. Now, taking a look at IPOs, initial public offering. That is basically when the company decides to sell their private company into the public marketplace. And that's very easily done. You get a corporation, an investment firm that is going to be an investment banker. And what they do is they organize the sale of the securities. Now, you are partial owner of the company significantly. You lose a major portion of your ownership right. So what happens is they go back to that 10 million shares that it was initially, and they can say, well, we got 9.5 million that we can issue. Let's issue 5 more million shares and go public. Now, when we see companies like Facebook and Google and all of them companies going public, we see it in the billions, okay? Billions of shares. That means you got to go back to the Secretary of State and say, okay, we want to be able to, issue billions. Here's our papers. Here's our income. Here's our, our company the past 10 years. This is why we feel, 10 billion is reasonable. So they say, yeah, you can issue 10 billion shares. That's authorized. Now, we just have 5 million that we want to sell out. So what is the company worth? We get it evaluated, and we feel that, $30 a share is reasonable. We would talk to the investment banker who investigates your company, and they say, well, we think $30 a share is good. Now, there are different types of IPO issues and how it's done. I don't like the old-fashioned way because the price fluctuated so much up and down. And then once it was sold out, it just went and then crashed. So there was for a long time called the Good Old Boys program with investment firms. And what they would do is they would say, hey, there's going to be an IPO of this company. We want you to get a bunch of that stock, and we think it's going to go up, 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 and then we'll let you go out and sell it. And then you'll make a nice, it was sort of an incentive or some sort of a reward for their better customers. And the SEC didn't like it. And a lot of people didn't, because you'd see $30 start and all of a sudden it's $100 and then it settles down to about 65. Well, the company only gets the $30. And the investors play in it, and it's the investment bankers that are playing the company. They're just coming up with a stupid number, and then they just ride the price up, and then it settles down somewhere. So what was developed was open IPO by a company called W.R. Hambrecht, and I'll get that information into you soon. It's in the chapters, and I'll have it posted. So WRHambrecht.com was commissioned. William Hambrecht is a brilliant man, and he developed what is called open IPO. It's an auction IPO, meaning you compete against the big boys as to getting the stock when it goes public. And all the funds, less the commission for the company like W.R. Hambrecht, goes to the company issuing the stock. It doesn't go to the good old boys anymore. If the stock goes up, 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 that means the company, the new company, may have gotten $40 here, but the stock went up like this while it was going. Okay, now it's at 70. Well, they're going to get 70 minus the commission charge. Okay, so That didn't happen before, and the SEC is very happy, and WRHandbook.com is basically the only one who does that. With the first startup, and they basically were commissioned to research how to avoid that. So if you're looking for IPOs, look at WR Handbook. They do some of the very biggest ones too now, for just that reason, because the company wants to get the money, more of the money than when the other investment bankers did. Okay, instead of the good old boys passing on incentives to people. So let's take a look now at values, common stock values. There's par value, there's book value, and there's market value. Let's take market value. Market value is what an investor is willing to pay. If you go into your broker and say, get me 1,000 shares of IBM, just give me the best price you can, he's going to put in a market order. And the next available price is what you get. What somebody is willing to sell to you is what you're going to get. That's the best price out there right now. It's not negotiated all the time, but it will be in a second. I'm going to explain how it can be. Now, market value is basically what the market bears, what an investor is willing to pay. Par value is much different. Par value is that amount, that half a penny or a tenth of a penny or a hundredth of a penny or even 1 penny maybe, that you tell the state when you incorporate. It's an arbitrary accounting number. It has nothing to do with the value of the company. It's for the accountants to work on. The book value. We did the balance sheet. So the book value is the owner's equity divided by the number of outstanding shares. That's the book value per share. Let's talk about rights and benefits of common stock ownership. Rights and benefits. You, as common stockholder, you have the right to vote. You have to vote on certain issues. There are some things that the company cannot do without the owner's approval. Okay. It cannot merge. It cannot sell out. It cannot, do a lot of things that, for example, if it sells semiconductors, it cannot go into an industry like the food industry without the approval of the common stockholders. Somebody gets an idea, hey, let's go into this industry, or let's do this and make this as well. That changes the whole nature of the business, of the manufacturing and everything. That has to be voted on, as well as the board members. You elect the board members. Now, there's two different types of voting: statutory and cumulative. Statutory is very straightforward. If you have 100 shares of common stock, and let's say there's 10 candidates for the board of directors, but there's only 3 positions that are open, and you own 100 shares, you can vote up to 100 shares up to 3 times. So you can vote 100, 100, 100. Or you can say, I only want one of them. Everybody else is a putz. Okay, you can vote 100 shares for one individual. You don't get to use your other 100 and 100. That's statutory. Cumulative. In the same scenario, you own 100 shares. There's 3 members to be voted in. Not 10 candidates, okay? You're talking about the number of empty seats that you're electing. 100 shares times 3 is 300 votes. You can vote those 300 shares any way you want. You can vote 299 for Fred and 1 for Barney. Okay? That's cumulative. The idea behind that is that it's a means to give the small investor, the minority investor, a bigger voice in the company. However, it also gives the bigger shareholders a bigger voice too. So I don't see it. But if you're taking a test with the federal government, they want you to answer it like that it gives the small investor a bigger voice in the company. They don't think about the other half. The government, what do you expect from them? Proxies. Proxy is like an absentee ballot. Proxy solicitation is when the company or another interested party wants your vote. They send out a proxy. Please send in your proxy. This is how the board of directors wants you to vote. Okay, so you vote it and boom, and you send it in. Then you get a call 2 days later. Hey, I'm Barney, and I want you to vote this way. Now, I sent you a proxy. Who's Barney? Who are you? Well, I'm one of the shareholders, and I don't like the way the business is being run. If they're going to put this and this and this together, that's what they want you to vote on. Did you vote? Yeah, I already did. Well, this is why I don't like that. And Barney gives his explanation. And then all of a sudden, the investor says, oh my gosh, you are so right, Barney. There's no way I would want them to do that. I didn't think of it like that. But I'm sorry, Barney. I just sent in my proxy 2 days ago. Okay, I'm sorry. Barney says, hey, no problem. You have my proxy? He goes, yeah, I see it there now, and I understand it now. Now that you explained it, it's plain as day. I would want to do what you want. Fine, do it. Send it, check it in, and mail it. The one that's received last is the most current. All the previous one are removed, erased. So it's the most recent vote that counts in a proxy solicitation. You can change your vote anytime up to the voting time. Let's take a look at preemptive rights. Preemptive rights is another benefit. This means that if the company is going to issue more stock, you get certain rights to buy that stock and you get it at a discount. They want current investors to buy into the stock that's newly going to be issued. Otherwise, it's going to dilute their position. You know, if you had 1% of the ownership of the company and they're going to issue new stock, they're going to give you the right to buy 1% of that new issue. You get to buy at least 1% of that. And you can also say, here's my money for the 1% ownership for these for the new issue, but put me down for another 500 shares. You can do that. And then any shares that are not bought by the other stockholders gets into a pool and it's sent out to the those that want to get more shares. They do that because, first of all, they don't want to pay the expense of going back to an investment broker to sell it and lose the money. They'd rather that money go to the investor, to their current stockholders. Now, how do you look for it? If you go into the newspaper, if you go into the Wall Street Journal or your own major newspaper, a lot of times they have listings in the New York Stock Exchange Composite is what they refer to. So look at that and find Ford, for example, or one big company that you're comfortable with. Look at their symbol. Ford is F. But if you look at F, there's like 30 of them. How do you figure it? F is the common stock. FA is, or FB, or FC, or FD are different issues of that same stock. What about a big F, RT, with a little RT, right? That's the rights that you were given. Preemptive rights. They're only 30 to 45 days in life, but there's a value to it. And we're going to show you how to calculate that value. But the easiest way to do it is, let's say they say, Mr. Harnett, you have the ability to buy 1,000 shares based on your current ownership. And they send me 3,000 rights. I'm like, what do I need 3,000 rights for? I mean, okay, I need to give them 3 rights for each 1 share that I want to buy. The board set that up. Now, 3 rights, keep that in mind. Add 1, that's 4. Divide that into the benefit that you're going to get. The benefit, let's say that the stock is going to be issued at, $40, but you can buy it at $32. There's an $8 benefit to you. Now, how much is that right worth? Well, I mean, each right, well, if it takes 3 to get a benefit of $8, that's it's 2 2/3 dollars. $2.67. That's what it's worth to me, but not to the investor, not to the investor, not to somebody who wants to buy it, and not to what they're going to put down on the New York Stock Exchange composite in your newspaper. They're going to take that 3, add 1, and then divide it into the 8. So that is actually valued at only $2. So if you wanted to sell the rights, you can sell it for $2 each. Let's say you don't have the money to buy more common stock shares. You still have value in those rights. How much value? You got 3,000 rights. And each of those rights is worth $2. So you can sell that for $6,000. Put that in your pocket. That's the company reimbursing you for lowering your ownership percentage. Now they issue all the stock and maybe you own 0.8 of 1%, but you got $6,000 in the bank. You can buy more stock with that if you want, or you can buy another investment. So rights have a value. You're going to see it listed. And as the stock price changes, it's going to fluctuate too. And keep in mind, I mean, if you don't do anything, you wasted $6,000. So you want to sell those rights if you don't have the money to do it, to buy it. Standby underwriting is when an underwriter, an investment banker, is in the wings waiting to see if your company needs help in selling some of the other shares. If the preemptive rights go well, all the shares are sold before, and you don't need to spend money on an underwriter. Okay. Let's take a look also some of the benefits. Limited liability. When your company is incorporated and you, for example, maybe you own the company or you are a stockholder, your liability is limited to your investment, the amount you invest in the company. So if you invest $10,000 in XYZ company and they're paying a nice dividend or they're growing and you're happy, but all of a sudden they get sued. And they get sued so bad that it's more than the company, and they have to liquidate. They're bankrupt. But let's say when they're bankrupt and all the assets are gone, that's still not enough to pay off the court judgment against you. They cannot go after you for more money. You may have a company that's not worth anything now because it's liquidated and turned over to the winners of the lawsuit, but they can't go after you for more money. They can't come to your door and say, knock, knock, knock. You invested $10,000. You have this many shares. Based on that, you owe us another $14,723. How do you figure that? Well, we won the lawsuit and blah, 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 and there wasn't enough to pay us off. Well, so what? We're incorporated. We have limited liability. You got everything, bye-bye. The company no longer exists. I lost my investment. That's it. So you see these 10, 20, $30 billion judgments on smaller companies. They're just trying to liquidate it on, bleed it out to total. Residual claim on assets. You also have residual claim on assets for common stock. That means that if you do liquidate, what's ever left after paying the liabilities of the company is split up to the different shareholders. And let's take an example of that. Liquidation does not mean the company is in bad shape. No, I mean, it sounds kind of stupid for me to say that, but it's not. I'm going to give an example of Frontier Airlines in Denver, Colorado. This happened almost 20 years ago, or 50, about 20 years ago. There was a dispute between the union and the management, and they were negotiating the contracts, and the Company said, no, we cannot afford to do this. We cannot afford to do that. Here's our books. Well, the union said, well, we don't believe your books. What do you think about that? And it says, we'll have to liquidate. If we don't have pilots, if we don't have workers, we're going to have to close the company down. Now, you can't do that. Yes, we can. We're the company. Well, that's not fair negotiation. Well, it is if you deny the books and still stand firm and you won't budge. We can't afford that. The company will go bankrupt anyway if we do that. So it's better to liquidate, because the board, while they're negotiating, or whoever's negotiating, has the best interest of the common stockholders. And in that situation, Frontier Airlines was dismantled, changed in a way that the union couldn't benefit. And the company still lives, and it flies right now. What happened was Frontier Airlines said, you got until a certain amount of time to agree to these terms, or we're going to start liquidation. We're going to change the company around. Nobody's going to have jobs like they did before. Some will, but not many. And that's what they did. They sold many of their planes down to Mexico. They sold many of their gates to other airlines. And yeah, there's a value to the gates. When you go into an airport and you see gate 24A or whatever, that airline owns that gate. It's like leased, and they can basically, it's sort of like a condo, and they can sell the rights to that gate. And they did, to probably, more than half. They kept some gates and they leased them. They kept some planes and they leased them. And Frontier Airlines, for a long time, became a leasing company instead of an airline. Then as time goes on, politics and everything, and labor and everything changes. Energy costs change. Hey, they did not renew the leases on the planes and the gates. And Frontier is flying now. Little leaner than before, but that is residual claim on a liquidation. Now, what happened? All those assets and all those planes and everything were built into the company while they distributed some of the assets. They had to. I mean, they didn't want to have a big fat cat situation and have the owners, the shareholders saying, well, what about us? You just can't just turn into a leasing company. They have to approve it. And they did. Inspection of the company books. Now let's go back and residual claim on assets. The common stock is the last one to get money paid out. So if a company does go bankrupt or liquidates, they sell all their assets, they pay their liabilities, whatever left is going to go to the common stockholders. But in the meantime, when they're paying their liabilities off, they're paying the bondholders. They're paying the preferred stockholders also before the common stockholders get paid. Okay. Now, inspection of the company books. You can get the books, but you don't get the full books. You don't get the accounting sheets and everything. You get the balance sheet, you get the income statements, you get other stuff. But you cannot walk in there and say, I own 100 shares. I want to see the company books. I've been listening to stuff on the news and blah, blah, blah. No, they'll kick you out. They have every right to do that. Everybody puts that demand, it would be detrimental to the company. You can't even get the minutes to the meetings. Let's take a look at a stock split. A stock split is when the company wants to change the price in the marketplace. They want to get the price down. Most cases, they want to lower the price. And sometimes they want to raise the price. And they do that by either taking back a bunch of shares or putting more shares into the market. Now, to do that, they have to do it to the current owners. They can't just flood it with other owners for free and lower your ownership. That's against the law. A forward split is when the company's price gets so high that they say, you know what, we want to get that price down so that we can get more investors looking at us. And that's accurate because many investors will look at a company stock at a certain price range only. If it's too high, they won't invest in it. So boards do forward splits to lower the stock price and put more shares out in the market. So a forward split, for example, let's say there's a 7-to-4, a 7-to-4 split. And you look at the number, the first number is 7. That means it's a forward split. So for every 4 shares that you have, you're going to get 7. You're going to have 7. An investor owns 400 shares, and the stock is $30 a share. How do you figure everything out on this? When you look at your account, it's going to say, let's say, $20,000 in that stock. When the split is done, it's going to say $20,000. You're just going to have more shares at a lower price in the market. And the easiest way to do that is look at the split number, look at the number of shares. If you have 400 shares, and the split is 7-to-4, you multiply by the first number, multiply by 7, that's 2,800. And divide by the second number, that's 4. That equals 700 shares, 2,800 divided by 4. So now you have, instead of 400 shares, you have 700 shares. So the company is going to send you 300 more, okay, in that split thing. But what about the price? How do you determine the price? You do the opposite. You divide by the first number and you multiply by the second. Sneaky math. So if it's at $30 a share, you divide 30 by 7 and you get 4.286. Then you multiply by 4. 4.286 times 4 is $17.14. So you started with 400 shares at $30, and your account now is going to show 700 shares at $17.14 a share. So they dropped that price down below $20. A reverse split is, well, a 4-to-7 split, or where the first number is smaller. What they're doing is they're taking away shares of you, but the price in the market is going to go up. And you're doing the same thing. To find the number of shares, you multiply by the first and you divide by the second. To find the price in the market, you divide by the first number in the ratio and you multiply by the second number. That's common stock. Let's take a look now at dividends. And we're going to talk about it very briefly. There's 4 dates that you need to know: the declaration date, the ex-dividend date, and the record date, and the payable date. What I want to emphasize, and I'm going to show this on a screen in the next episode, is the dating, the calendar, and the buying and selling of your stock if you're in that dividend month. Now, let's say, for example, it's April, and the board meets at April 3rd, and they say, let's pay the shareholders a dividend. Well, that's the declaration date, April 3rd. They then say, we're going to pay the dividend on April 30th. And they say, why 30th? And they say, well, it's Greg's birthday. Yeah, it is my birthday, April 30th. So that's why I picked it. We're going to get that dividend April 30th. And the record date is the 19th. Record date. That means people on the books, on record, of owning the stock on our books on the 19th, at the end of the day, they get the dividend. The other is the ex-dividend date, and that's set by FINRA, the organization that oversees a lot of this. But it's kind of obvious because it's going to be the business date before the record date. And here's why. Let's say you want to get that dividend. Well, no, you don't. And you're saying, well, Craig, it's a 5% dividend. I want the 5%. I'll just buy the stock and then bingo, I'll have 5%. No, you won't. Because they're going to drop the price 5% the next day, very next day. So on the 18th, the price is going to drop X date, X dividend, meaning you don't get the dividend on the 18th. Even though it says record date the 19th, I don't get it. That's right, because it takes 2 business days to settle and show on the company books that you're the owner. You're not going to be the owner on the books of the company until the 20th. You will own the stock in your hand, in your bank, in your brokerage account, but you will not own the dividend. And that's when you want to buy the stock. If you're interested in a company very much and you want to get that dividend, you are going to buy a dividend and you are going to buy a tax liability. You don't want it. On a broker's side, it's called selling dividends. They can lose their license for it. On an investor side, it's buying a dividend. And okay, I can't say it any other way else. It's stupid. Don't do it. Because what's going to happen? Let's say it's a $20 stock and it's going to pay a $1 dividend. That's 5%, right? Yes, it is. I got it right. Now, on the 18th, the stock price goes down to 19. You can buy the stock for $19 a share on the 18th. But right now, on the 17th, it's $20. And you say, but I'm going to get a dollar dividend. It'll be $21. No, it's not. Because as soon as you buy it, you're entitled to that dividend because it's going to settle on the 19th, the record date, and you're going to get the $1 dividend, but your stock price is going to drop to 19 the very next day. And then on the 30th, they're going to send you $1 dividend for every share. And they're going to send you a 1099 div, meaning that you owe taxes on that money, even though your account didn't grow 1 penny. It dropped, and then you get the money back as a dividend. So it's a bad, bad situation. If you want the stock so bad, buy it on the X date or later, and you got a lower price and you're fully invested. Okay, we'll go over that, and we're going to go over a bunch of other things. But I just wanted to touch base with common stock, get you interested, get you involved in it. We'll go more into depth on REITs and REITs, rights, warrants, all the other equities. We're going to talk of ADRs. We're going to also talk about, later we're going to talk about preferred stock. And, there's a bunch of different types of preferred stock. Then we're going to talk about basic management and strategies for common stock, how to manage a portfolio, how to develop a portfolio, different strategies that your stockbroker is taught, and then strategies they're not taught. Okay. Why? Because I don't put it in the books, because it's not going to be tested on. So they don't know everything. And in fact, you're going to know more than your stockbroker by the time this is done. So get ready. I want to thank you for showing up. I usually try to keep it 45 to 55 minutes. Sorry I went over this time, but hopefully you learned a lot. You got some conversation, and feel free to contact me. You can get a hold of me at Gregory at 65exam.com. You can get the Investor Handbook at that place. You can contact me and I'll arrange for it. And yes, it costs. Everything costs in this world. But it's going to be the best investment tool that you ever buy. And it's not like what you're going to see on TV and in the emails and everything about this super guru program or anything like that. It's just common sense and investing over the years. And it's going to show you how to make money when the market goes up, when the market goes down, and when the market does nothing, it just stays sideways and a little jumpy. That's it. You're going to be able to make money anyway. But stick with the whole program. Stick with the whole course. Stick with all of the videos, because just learning common stock and then jumping to the end, you're going to lose your shirt. Okay? I'm going to show you how to integrate different investments into a portfolio. I'm going to show you how to make money when everybody's panicking, losing their shirt, and you're going to be praying for the next market drop adjustment or crash, as some people foolishly call it. Take care.